Hello, and welcome to another segment of ARA in Conversation. I'm Stanley Iezman. I'm Chairman and CEO of American Realty Advisors. And joining me today is Sabrina Unger, our Managing Director of Strategy and Research, who resides in our New York office. What we want to talk about today is the housing market and the impact on every one of us, because all of us need housing, whether it's for rent or to buy. And we want to really delve into this in a robust way and try and examine what the key issues are that are impacting. So 2024 and 2023 actually, has been a really interesting year in housing. Why don't you tell us what those interesting factors are and what that was?
Yeah, and interesting is exactly the right word. I think anybody that tried to buy a house in 2023 maybe recognized how limited the options were. And if we look back, the number of existing home sales that occurred in 2023 were the lowest in 30 years. So they are even lower than the number of sales that occurred during the subprime loan crisis. So, it's the lowest full year of sales since 1995. Now, normally, if you're a homeowner and you're hearing that stat, you might think, oh my gosh, that's terrible that there's so few homes being sold. But the reality is this is not a demand issue. This is really a supply issue. And a lot of it is being driven by what's happening with interest rates. Effectively what we saw is the rate on a 30-year mortgage jump up pretty considerably. And so if you're an existing owner and you have a mortgage in place, you might think, wow, my home appreciated 30% in the last 5 years. I should sell out of this house, take that money, go buy a newer house down the street. But then you start to look at it and you'd say, well, now I have to buy at today's much higher prices. So that doesn't sound terribly appealing. Oh, and by the way, my 3.5% interest rate that I locked in 5 years ago, now it would jump to 7+%. That doesn't sound terribly appealing. And so even if you could find a home that was priced exactly the same as what you were selling your current one for, which we know that's not likely, but let's assume you could, just the difference in interest rate would make your monthly payment increase something like 19%. And so for a lot of people, that math just doesn't make sense. And effectively, it's keeping people staying in their existing mortgages longer and keeping resale inventory incredibly low and the market very, very tight. So that's what sort of happened in 2023. For 24, again, I think there's an expectation that market will start to unlock a little bit. But even so, I think we do not anticipate that prices are going to come down considerably. So even if you have an improvement on the interest rate, the absolute price you're paying for a home because of that supply-demand mismatch is it's still not going to be terribly accessible for a lot of people.
So let's pivot to the interest rate question now, because there's two parts to this. One is that people become anchored based upon prior experiences that they have, where all of a sudden they think that the world is always going to be 3% interest to buy a single family home, and that isn't really the case. And then on the other hand, we're sitting here and we're trying to handicap, and very dangerous game, by the way, of trying to handicap where interest rates are going to go. But we're trying to handicap what the Fed is going to do over the next year in terms of interest rates. So do you think that the Fed is going to be dropping rates, and would that necessarily stimulate more people to buy single family homes?
Yeah, I think if you take the Fed at their word, they're sort of anticipating a couple cuts in 2024. Let's call it 3. The timing of that could be in the latter half of the year, given what we had seen in the most recent inflation prints in the fourth quarter of 2023, the strength of GDP growth. So could take a little longer, I think, than what markets had originally anticipated. So let's assume that you have 3 cuts of 25 basis points each, and so interest rates drop at that end of the curve by 75 basis points. The reality is on the 30-year mortgage rate, which is what a lot of buyers will use, that has already come down from peak. Peak 30-year mortgage rates were pressing up against 8% in October of 2023. And today, depending on the day, they're about 100 basis points lower. So we've had to, see that we've already come off peak rates. It's stimulating a little more activity on the for sale side. But again, 90% of Americans with a mortgage have an interest rate below 6%. So even though we're now below 7%, we would need to see it drop at least another 100 basis points just to be essentially at par with where 90% of people have their mortgages today. and the majority, it's actually below 5%. So you're really effectively having to take a bet that interest rates drop 200 basis points to sort of maybe make the interest rate part of the equation of selling your home justifiable or interesting to homeowners. And I don't think any of us anticipate that that occurs, certainly not this year. And there would need to be something much more dramatic happening in the economy, even heading into 2025, where we would be at that low of an interest rate. So don't anticipate that a lot of people that are in that lock-in effect are going to suddenly become incentivized to sell their homes because interest rates drop 25 or 50 basis points.
So, as an anecdote, when I bought my first home, I was paying 13%, and I thought it was a godsend when it dropped down to 11%, and I refinanced a year later, and then I was even more shocked when it dropped to 9%, and I did it again. It was always 9%, and then it dropped to 7%, and then it dropped to 6%, and now we're talking about that the norm should be less than 6%, and the interesting thing is does that, when that happens, is that going to stimulate more demand? And is that demand going to be the right demand? Are those the right people to be buying single family homes?
Yeah, I mean, I think if you see rates drop below 6%, so let's play out this hypothetical a little bit, I think you will see a surge of people come off the sidelines that have been wanting to buy and have been priced out, or the interest rates scared them away, or some of that resale activity comes back in. The challenge is that all of that pent-up demand is going to have an effect on prices. So you've effectively got two parts of the lever when it comes to what you're going to pay on your mortgage. It's the price you're going to pay for the home and the interest rate on that loan. So even if the interest rate part comes down and that releases a lot of demand into the market, you're going to see prices continue to increase. And so net, you're probably still paying quite a bit for a mortgage. And I still think that's going to make it very challenging for today's renter to be able to break into that market. What I think that does from a safety valve perspective, though, is that it does sort of ensure that somebody that maybe could afford a mortgage if the rate was 5.9, but they can't afford it at 6.1, or they could afford the house at $350,000, but not at $400,000. When those people, to me, that's the sort of fragile demand that can create bigger issues. So while it's difficult, I think, for people to recognize I still can't buy a home, I think it gives us a little bit of a safety valve in terms of the quality of people that would be able to transact in that market.
So since we happen to be a big buyer at American Realty Advisors of build-to-rent properties and residential for-rent properties, why don't we pivot to what the opportunity set is there, given what is happening in the cost of single-family homes today and the inaccessibility that exists?
Absolutely. And you said it perfectly, right? We really participate in the rental market in effectively two pillars, which is the traditional multifamily apartment complex. And then we are also very active in this purpose-built single-family rental space. And what I really like about that is we are being additive to the stock. So we're not competing with Joe and Jane down the street who are trying to buy their first home and buying up the scattered homes in the community. We're actually adding stock, and we're giving people an alternative sort of style of living without the burden of having to come up with that down payment, deal with the interest rate question. They get that single family home experience at a much lower cost. So we like that space. And what I said earlier still holds. If you can't buy a home in this environment, whether it's price, interest rate, down payment, whatever combination of factors is keeping you out of that market, unlike a lot of other property types where, if you're a small company, you say, gosh, I can't afford my office rent. Well, everybody work from home. We don't have that same option when it comes to housing. There is no alternative. If you can't own your home, there are effectively a couple options. You can live with your parents, maybe if they own their home, but likely you're going to be in the rental market. And so given sort of structural tightness, we're talking about that lock-in effect of so many people having really low mortgage rates and home prices just being really unaffordable. I think we're going to continue to see this demand for residential hold up over the next 3 to 5 years at the minimum, because there's just so many people that cannot afford to get into the for sale market. What I think is interesting is what you're seeing in fundamentals on apartments today is that they are becoming a little weaker just because of the amount of supply that got delivered in 2023 and what's expected to deliver this year. But it's doing something really interesting from a market perspective, because if you think about some of the winners of this most recent cycle. So the Phoenix, Austin, Atlanta, Miami's, Orlando's of the world, part of the reason that they were winning and having so much rent growth was because people were moving in mass because it was affordable. Well, then what happened is all these people move in, they're coming from the coast, they have higher incomes, the rents shot up in some instances 15, 20% or more year over year, and that shrunk the affordability gap between a place like Austin and, a market in California. And so when it becomes less affordable, the inflow of people may stall out a little bit. Well, now what we're seeing is all this supply, while it's not great from sort of a short-term operating perspective, we have to be a little more competitive in those markets. It's refilled the affordability gap for those markets relative to the coast, and I think that will reinvigorate the flow of people that go into those. So on the long term, I think it's actually a positive for the demand outlook there.
So you and I have spent a lot of time talking in investment committee about the opportunity in multifamily and for rent residential. And I think that we're pretty convicted that there's a great opportunity as a result of the great reset in pricing today. Why don't you just talk a little bit about that?
Yeah, I think, again, we think about where the potential distress is from the debt side. So it hasn't materialized in distress yet, but there were a lot of very creative things happening in multifamily financing. There were a lot of syndicators who maybe hadn't, sort of lived through an entire financing cycle, and now they're facing much higher rates and are also facing a more challenging lease-up environment. So there are going to be some great assets that are brand new. It's where people want to live, and they're going to come at us at a really attractive basis. And so we know when we look back to past downturns, so whether it was an economic downturn or real estate downturn, the year sort of coming out, right? There are some good vintage year buys. And I think 2024 is going to be a year we're going to look back on in 2, 3, 5 years and say, we had some incredible acquisition activity in the multifamily space because we had a targeted geographic approach. We know who our renter is. We know how to operate these things through cycles, and we got them at a great deal.
So we've talked about this a great deal about your submarket selection process. I mean, walk us through the identification of some of those key submarkets. What are the drivers that really focus on why those markets are going to outperform on a revenue growth basis and an occupancy basis and thus a value basis?
Yeah, I think, there's a lot of things happening in real estate research and real estate in general that's very technical. Predictive analytics and algorithms and all of those things are exciting, and they certainly help us do our work. But at the end of the day, it really does come down to what drives demand for space. And so when we're talking about housing, what drives demand for rentals? It's people. Where do people want to be? And so we can look at historical data and projected data, population growth, employment growth. Obviously, people have to move where they have a job writ large. Obviously, the work from home thing has shifted that a little bit, but where are the businesses? What are the factors that have driven businesses to be centered in a certain market? And are those factors changing or appearing other places? And so, again, I'll use 2 examples sort of coming out of the pandemic. If you sort of looked at a place like New York early in the pandemic, all the headlines said, the city is dead, no one's moving back, this is terrible. Well, and then basically within, the flip of a switch, people started moving back first. And this was before their businesses called them back into the office. There was something about New York that brought people back, and the demand for apartments surged, and we had some really strong rent growth. On the other side, I look at a market like Boise, which for a couple years was screening really well in the pandemic, right? Because all the people from the Bay Area and some Seattle and Portland got to work from home, and Boise was cheaper and had the lifestyle element. And so there was a flood of capital to get into that market. Everybody said, I don't want to miss the next Austin. I'm going to go build a bunch of apartments in Boise. And while I think the first movers probably made money, the reality is that you sort of get caught up in this wave. And now, I just saw at the end of 2023 that Yardi Matrix said Boise was the 120th market for rent growth out of 121 markets. So this idea of chasing momentum in a market can be really challenging. And so, sort of get at the question, how do we identify the markets and submarkets that we want to be in? You have to look at, are the drivers that are bringing people in sticky and resilient? And so when you look at a place like New York, it's taken decades to have the presence of industries and the dynamic employment market and all of these things, and they don't tend to leave quickly. It takes a long time to get that critical mass. It takes a long time for it to go away. Boise was missing some of those elements. It was really an affordability play, but it lacks connectivity. The diversity of its local economy and the job base is not as dynamic. And so that's been a little bit of a fleeting market. And so I think you really have to look at what drives people and businesses to be in certain places.
Well, Sabrina, thank you. That was a great conversation about the housing market, and we're very excited that you were able to come out here and join us to be able to talk about this.
Yeah, thank you.